Your risk management is more important than your forex trading strategy. Yeah, that might sound very weird to you, but that is the truth actually. Most traders don't blow their accounts because of bad strategies. They blow their accounts because they don't understand the risk management. Risk management is key. When a lot of people have heard that many times, but they don't seem to understand why they say this. Risk management is key in forex trading. That is how you're going to be able to know if a strategy works or not. If you do not apply risk management in your trading strategies, trust me, you will not be able to find out if a strategy works or not. In this video, I'm going to drop everything you need to understand. I'm going to explain 3 concepts about risk management for you to fully understand how risk management can transform your trading journey. Honestly, in order to fully grasp and understand what we'll be discussing in this video, you'll have to watch this video to the end and begin to immediately apply all the concepts and risk management strategies that will be discussed in this video. Now, stick around, and I'm going to keep everything simple and easy for you to implement. Simple and easy to understand, so you'll be able to implement it straight into your own forex trading account. Now, let's dive right into the 3 concepts we're going to be talking about in this video. So these are the 3 concepts we'll be talking about and discussing in this video. Let's start with the first, which is your trading capital. Now, your trading capital is simply how much you have at disposal. How much do you have to trade? This is very simple to understand. How much do you have to trade actually? Not how much you have to leave. How much do you have to trade? Take this example. If I was someone who has just $1,000 now and I want to deposit into my forex trading account, it will be very unsmart of me to deposit the whole 1,000 or even 800. You have to deposit an amount that you're okay with if you lose the money. See, any money you deposit in your forex trading account, just put it in your mind that the money is gone. The money doesn't belong to you again. The money doesn't exist anymore. You understand? Never put your feeding money, your fees money, your healthcare money, never put it into a trading account. Believe me, you would not be able to trade properly with it. There's going to be emotions everywhere. You're not going to be able to execute without any flaws. Clean execution, that is what is needed in forex trading. So when you have all these obstacles in your way, you're using money you're supposed to use to eat, or using money you're supposed to use to go transportation or leave for a month, you deposit everything into your trading account. It is not possible for you to trade properly. You would not be a good trader. You won't be able to execute properly. Your trading capital is very, very important. Believe me, do not deposit money you cannot afford to lose in your forex trading account, because if you do that, you're just shooting yourself in the leg. Actually, you're sabotaging your whole process. Your whole trading, you're sabotaging it with your own bare hands by simply depositing the wrong amount of money in your forex trading account. Now, the money doesn't have to be big, it doesn't have to be small. You should deposit what you're comfortable with. You understand? Imagine the amount you're going to deposit. If you lose it today, how would you feel? These are factors you should consider before depositing any dollar into your trading account. You shouldn't just, because you're seeing people online depositing thousands of dollars, you would now go to an extent, and some people won't go as far as selling properties to just deposit in their forex trading accounts. You see, all these things will just put you in a position where you don't want to be in. Believe me, you should only deposit money you can afford to lose. Now, the money doesn't have to be big. If you're just starting out in forex trading, it is advised you start with a small capital so you're able to understand your strategy, your risk management, be able to build confidence in yourself for trading. Now, this is very crucial. When I was trading, that was like 5 years ago. I started with how much did I start with? I started with like $50. It wasn't even my money. And also, one thing, do not trade other people's money. That is very important. Try your best not to trade other people's money if you don't know what you're doing. Avoid it, because bro, you could go into a lot of debt if you try it. I tried trading with other people's money, it blew, but luckily for me, good for me, the person was my friend. Yeah, it was my friend's dad who gave me that money to trade. So I advise you, do not trade people's money. When I was trading that account, believe me, I was on the edge. Every trade was on the edge. I even missed a gold trade that could have made me a couple of dollars. Then it could have made me more than $1,000, because I had a very good entry and all. But then, because I was scared about losing the account, I closed the trade too early because I was in a drawdown. I wanted to bring it back to profit, so I closed trade too early and just made a few dollars from that single trade, and the money ended up blowing because I was very emotional about my trading. So avoid trading people's money. Avoid trading money you cannot afford to lose. Trade with money you know you're very comfortable with losing. It doesn't have to be a huge capital. If you're just starting out, it's advisable you start with $10, $100, any amount you're comfortable with losing. So you're able to master and understand your forex trading strategies and everything you need to know about your strategy. So that's that about trading capital, which is a very, very important factor for you. It could actually make or break you. You understand? It could make or break your whole trading journey, to be honest. So be very careful about how much you deposit into your forex trading account. Be very careful about it. Deposit only money that you can afford and are comfortable with losing. You understand? So that's that about your trading capital. So moving on to the next, which is risk per trade. Now I'm going to give you a practical example of what this means. I'm going to give you a practical example of what I'm trying to say. In this section, we'll talk about lot size calculation. How many percent of your account are you willing to risk for trade? And what style of trading, how many trades can you take up place at once? So I'm going to be discussing about how many trades can you take up place at once. I'm going to be discussing about each and every one of this. So you're talking about risk per trade. Now, how many percent of your accounts are you willing to risk per trade? Now we're going to start with the balance of, let's just say you have $100. Now, you understand that $1 equals 1% in $100. So how many percent of your account are you willing to risk? That's something you should consider before taking any trade. That's like you should have a consistent percentage of risk in your trading journey. Now these are lot sizes. Now what is a lot size? A lot size is simply how many units of a currency you're trading. That's what a lot size is simply. It's just like a volume of the trade. Like the bigger the lot, the more each pip movement is worth, and the higher the risk. You understand? Now let me break this right up down for you. Now a standard lot means each pip. Now the forex market moves in pips. Each pip is worth $10. So imagine you take a trade and your stop loss is 10 pips and you use a standard lot size. You understand? Use a standard lot size and you take a trade and your stop loss is 10 pips, means that's 10 times 10. You know, means you're risking $100 on that trade. Now that would be very dumb if you have $100 in your trading account and you're using one lot to risk. One lot to take a trade rather. That would be very absurd. Now if you're using a mini lot size, which is 0.10, it means every pip in the forex market is worth $1. Now if you take if you use a 0.10 lot size on a $100 account and your risk and your stop loss is 10 pips, that means your risk, that's 10 times 1, that's obviously $10. So you're risking 10% of your account in a single trade. That's what you're doing essentially. Well, not everybody can handle that. As a beginner, I do not advise you to do that. Now, let's move on to micro lot. A micro lot means 0.01. That means each pip is worth $0.10. That's 0.10 cents rather. That's what one pip is worth if you're using a micro lot size of 0.01. Now, imagine you're risking, you take a trade and your stop loss is on 10 pips. I'll talk about pip later on. Your stop loss is at 10 pips. And use a 0.01 lot size. That means you're risking 0.10 cents times 10. That's equals to $1. You're risking $1 on that particular trade, meaning you're only risking 1% of your account in a single trade. I hope that's clear. For you guys. If you don't really understand, you could just rewind and rewatch it and try to understand what I'm talking about. It's simple. There's a standard lot size. This 1, 2, 3, 4, 5, 6. It goes all the way to 100 lot size. That's the maximum lot size, 100 lot size. In 100 lot size, one pip is equals to $1,000. Do you understand? If on a one lot, a standard one lot, one pip is worth $10, then 100 lots, one pip will be worth $1,000. It is actually that simple. So yeah, 0.10 means one pip could be worth $1. You understand? So now depends on your account size. That's going to vary on how many lots you're going to be able to use on your forex trading accounts. Now be very careful about this. Now let's move on to, let me give you a practical example of how you should apply a lot size in your forex trading. Now I'm going to show you an example on my phone right now. Okay, now imagine you're supposed to take a trade here. This is a very good zone for me to take a trade, take a sales. Now you have to take a trade here, and you fix your stop loss to about 10 pips. Yeah, this is 10 pips, and then your take profits all the way down here. So now, this is how to calculate the lot size you're going to be using for a $100 account if you're risking 1% of your account. And I'm going to head over to my position size calculator. Just open it and put your balance. We're going to put $1,000. Now GBP, JPY are risking 1% and then a 10 pip stop loss as we already are raising on our trading view. Now we just calculated our lot size for us, which is 0.147, which is essentially 0.14. Now let's head over to our MetaTrader. Now let's impute 0.14. Yeah, as you can see, it's already imputed here, 0.14. Go ahead and then just place it sell just to see if it is accurate or not. Now stop loss, which okay, check our stop loss here. Okay, pips, 10 pips on the dots. Yeah, exactly. Okay, yeah, that's accurate. This is 1% of $1,000. You understand? Like in some pairs it may vary, so it's a bit 10, but some pairs have a little bit of deficiency and difference in price. So we just put it in. Yep. So basically, you can see how accurate this is. Then you go ahead and place your trade. But this is a demo account, so we're testing it on the demo account to see if the position size calculator is accurate or not. And what does it say? It means if we trade a 0.14 lot size on this trade right here, it means we're going to lose just $10 from a $1,000 balance. Do you understand? And if we win, we're going to win $60. You understand? We're going to take it just beyond 6. We're going to win $60. That's what this means. Essentially, that's what it means. So I think that's that about lot sizes. It's very simple and very direct. If you don't know how to calculate it, you could just head over to the lot size calculator and imputes all your trading details there. It's going to give you the lot size you're going to use for that specific trade. Now there's something else you should know. You know, when you're in a single trade now, you're risking already 1% of your account. So now you have to decide how many trades can be open at once on your trading account. So if you open 1, 2, 3, 4, 5 trades at once, that means 5% of your trading account is on the line. So always consider the amount you're going to be able to risk in total. Do you understand? Do not just place trades recklessly because you're risking 1%. Everything's going to accumulate into something. So how many trades can you place at once? Once you've got your lot size, you determine how many trades can you place at once. These are just the basic things you need to understand. All this comes under risk management. Now moving on to a very important part of risk management, which is the risk to reward. Now this is a very crucial and lots of traders miss it here. Let me explain. I'm going to be explaining everything you're seeing in this diagram. This is about risk to reward. Now the first thing you're seeing here, you're risking Now the first thing you're seeing here is you're risking 1% of your account to make 0.5. That means if you're risking $1 in a trade, you're going to get 0.5 cents or dollars back. That doesn't make sense, yeah? That's very wrong. You shouldn't do that. And you need a strategy with a win rate of 70% to be profitable, no, to be break even self. If you're risking 1% to make 0.5%. Moving to the next one, you're risking 1% to make 1%. That means for every dollar you risk, you get $1 back. That is simple. You need a strategy that has at least 50% win rate, which is quite rare to find, to be honest, because a lot of successful traders out there have a less than 50% win rate in a lot of them. So then, honestly, looking for a strategy that has a 50% win rate might be just difficult for you. So moving on to the next is when you risk 1% to make 2%. Now this is the best risk to reward you can have. This or higher. You should have at least a 1 to 2 risk to reward or higher. The more the better. This is very important because for every dollar you risk, you get $2 back. Do you understand? You get double of what you risk. That is if you're risking 1% to make 2%. I mean, that's the whole purpose of trading, right? You can't be risking a huge amount of money to make something less. That's not the whole purpose of trading. Or risking $1 to get multiple, even triple, even maybe 4 times. That's the whole purpose of trading. So now, when if you have a risk reward of 1 to 2 risk reward, you just need a strategy that has a win rate of 35% to be break even. Do you understand? You need a strategy that has a win rate of 35%. So now what you do when you enter a trade, you set your stop loss and take profit orders, you calculate your risk to reward ratio and access your trade outcome to make better decisions. Now let's go to the chart and see what I'm talking about. Now looking at the charts, this is what I was discussing about previously. I said you should never take a trade that when your risk reward is below 1 to 2 risk reward. Now this this is a trade I took yesterday, which is 1 to 2.65 risk reward ratio. You should never take a trade when you see the risk reward is this way. Anything that's less than 2, never take the trade. Never. Do not take the trade, because you want to be at least getting at least double of the money you're risking when trading. That's the whole point of trading forex, right? Getting at least double the money you're risking. That is good. That's what's going to help you become profitable in forex trading. If you're taking anything less than 1 to 2, trust me, you're doing yourself no good. The higher the better. You should take trades. This is 1 to 7. This for every $10 you risk, you're getting 70 back. This is a 1 to 4. For every dollar you get $4 back, and on and on. The higher the better, but never take it less. Never risk more than you're going to win. So with all that being said, remember that trading is not about how much you start with. It's about how well are you able to manage what you have. How well are you able to maximize your profits? How well are you able to execute trades flawlessly? You should focus more on your consistency and be disciplined, and always, most importantly, protect your capital. That is using proper lot sizes, using proper risk to reward, and measuring and calculating your trades properly. Once you're able to master all this I've said in this video and understand all these concepts, scaling up becomes very, very simple for you to be able to scale up your accounts, grow your accounts from $100 to 200 to 300, even fund more, trade bigger capitals, and maybe even move on to prop firms if you're disciplined enough. Prop firms would offer you $200,000 to trade, and if you're able to trade properly with good risk management, prop firm trade is all about risk management. If you have a good risk management, you easily pass a prop firm. I've passed prop firm in the past, I don't trade prop firms anymore, but then you can trade prop firms and pass and have access to big and better capitals. So yeah, you can also do it too. You can also be the good trader that you want to be. All you have to do is master risk to reward with a good trading strategy. If you enjoyed this video, drop a like and subscribe to this channel to get more and better video like this in the future. Always be robotic, guys.